Welcome to This Explainer. Okay, so today we're diving into something absolutely massive, the high-stakes world of the current AI boom. But more importantly, we're going to peel back the curtain and uncover a hidden financial ecosystem to see how the private stock market actually functions behind the scenes. If you've been glancing at the headlines lately, you know the artificial intelligence race is reaching a total fever pitch, and the financial maneuvers happening right now, well, they're literally going to rewrite the record books. So how on earth do everyday investors navigate all this? Let's find out.
To really grasp this current IPO frenzy, you just have to look at the stark contrast between two heavyweights in the space right now. Take Anthropic, the maker of the Claude chatbot. They've seemingly achieved the holy grail of AI, actual profitability. They reported preliminary revenue exceeding $11.5 billion in Q2 of 2026 and are projected to earn a positive operating profit, all while targeting a mind-boggling $2 trillion valuation. Then, on the flip side, you have OpenAI. Despite pulling in a massive $13 billion in revenue in 2025, leaked financials reveal a staggering $39 billion net loss. It's basically a tale of two completely different financial realities, both racing toward the public market.
So, here is our roadmap for today. We'll be covering 1. The AI IPO frenzy, 2. Inside pre-IPO platforms, 3. The S1 filing process, 4. The historical IPO reality, and finally, 5. AI tools for post-IPO.
Section 1. The AI IPO frenzy, trillion-dollar value.
Section 2. Inside pre-IPO platforms, access private shares. You might be wondering, how do investors actually get a piece of a private tech giant before it hits the big time? Enter the secondary marketplace. Think of it kind of like a high-stakes waiting room. Platforms like EquityZen bridge the gap here. The process goes like this. First, accredited investors join the platform. Then, they buy pre-IPO stock directly from early employees or founders who are looking to cash out some of their equity early. Finally, the investor just has to hold onto those shares and wait for a massive exit event.
But here is the crucial catch. Once you buy in, your money is essentially locked in a vault. It isn't liquid like a standard brokerage account where you can just sell whenever you want. You're stuck waiting for one of three things to happen: an IPO, an acquisition, or an express deal, which is where you manage to sell your allocation to another accredited investor on that exact same private marketplace.
Section 3. The S1 filing process, path to public market. The bridge moving a company from those private platforms over to the actual public sphere is a massive bureaucratic hurdle known as the Form S1. This is the SEC registration statement containing the deep dive prospectus. And get this, while the online form itself is only about 8 pages long, the SEC estimates it takes an average of 972 hours of work to prepare. Yeah, almost 1,000 hours. That is a whole lot of billable lawyer hours just to make absolutely sure the public knows exactly what they're buying into.
Now, here is a seriously fascinating loophole that both OpenAI and Anthropic have taken advantage of. Thanks to a piece of legislation called the Jobs Act, emerging growth companies can actually file their Form S1 confidentially. This means they get to go through the SEC's rigorous review process completely in secret, keeping their highly sensitive financial metrics totally hidden from competitors. They only have to make the contents public 21 days prior to their IPO roadshow. Basically, it lets them test the waters without showing their entire hand to the market right out of the gate.
Section 4. The historical IPO reality, expectations versus data. All right, so the company goes public, the opening bell rings, and the hype is just off the charts. But taking a look at data from Veracity Capital, we really need a reality check here. There's this pervasive illusion out there that getting in on an IPO is a guaranteed golden ticket. But history tells a very different story, showing that IPOs are often pretty underwhelming entry points for regular investors. Let's break down exactly why that is.
First off, the truth is that IPO access is definitely not a level playing field. Allocations flow through a really strict tiered waterfall system. The lead underwriters and massive investment banking partners, they grab the largest segment of shares right off the bat. Then smaller portions trickle down to syndicate members. Finally, whatever's left over might make its way to custodial platforms. Because demand for these high-profile tech IPOs astronomically exceeds supply, retail investor requests are almost always scaled back. You might ask for 1,000 shares and, well, only receive 10.
And here is the brutal mathematical reality that honestly catches a lot of first-time investors completely off guard. For the largest U.S. IPOs since the year 2000, the median maximum drawdown, which means the biggest drop from peak to trough in the very first year of trading, is a staggering negative 53%. Think about that. Even for companies that go on to be massively successful in the long run, early price discovery is incredibly volatile and often really bumpy.
Looking at historical performance data from 2010 to 2024, newly public companies actually underperform comparable public benchmarks by roughly 8 to 9% in their first year. Why does this happen? Well, IPO pricing embeds a ton of massive optimism, and the early supply of shares is artificially constrained. But as soon as those early lockup periods expire, pre-IPO investors suddenly flood the market to cash out, and that puts massive downward pressure on the stock price.
Section 5. AI tools for post-IPO. Data-driven decisions.
Because that initial IPO debut is just so incredibly volatile, let's explore a different strategy for once these companies are safely trading on the open market. Retail investors now have access to some amazingly sophisticated AI tools, like Prospero.ai, Seeking Alpha Premium, FinChat, and StockRover. These platforms compress millions of institutional data points into totally understandable metrics, effectively stripping away all that early hype.
You can really tailor your tool set based on your own specific investing style. For example, if you want to understand the hidden movements of big money, a tool like Prospero.ai uses AI to process complex institutional data sets, things like order flow and options positioning, and distills them into 10 plain English signals. On the other hand, if you're a fundamental investor who just loves diving into the weeds, FinChat acts like your own personal junior analyst. You can actually converse with the AI to instantly extract specific data points from hundreds of pages of dense SEC filings and earnings transcripts.
This honestly represents a huge shift in modern investing. AI is actively taking the massive computational power that used to be strictly reserved for Wall Street hedge funds and is putting it right in the palm of your hand. It allows everyday investors to make calm, data-driven decisions based on institutional flow and fundamental reality, rather than just blindly riding the emotional roller coaster of early IPO hype.
So as titans like OpenAI and Anthropic gear up to write the next chapter of stock market history with their trillion-dollar valuations, I'll leave you with this to ponder. As an investor, do you really want to navigate the high-risk, high-reward waiting room of pre-IPO platforms? Or will you let the data safely guide you post-IPO once the initial dust has finally settled? Thank you so much for joining me on this explainer, and remember, always keep your eyes on the data.